Muy buenas tardes a todos y bienvenidos a su cita semanal con los principios de las finanzas responsables y la inversión consciente aquí en Value School. Volvemos con uno de nuestros eventos habituales después del parón estival, y también aprovecho para saludar a todos nuestros asistentes en sala, los que nos siguen también desde streaming, y también un saludo especial para todos aquellos que nos estén viendo ahora mismo en grabación, ¿no? Pese a que hayamos tenido, como comentaba antes, pues este es nuestro primer evento de este nuevo curso lectivo, por así decirlo, pese a que hayamos tenido dos conferencias anuales las semanas anteriores, tanto una de Numantia con Emérito Quintana y otra de One Capital con todo el equipo. Pero bueno, hoy tenemos con nosotros a Peter Smith, que sé que me va a permitir este pequeño momento para hablar un poco de los anuncios y de las actividades aquí de Value School. Peter también conoce el idioma, pero vamos a hacer el evento de hoy en inglés, así que sirva también eso de disclaimer. Peter, no sé si quieres decir algo en español.
No, es difícil.
Difícil.
Mejor en inglés.
Pues como bien comentaba, empieza un nuevo curso lectivo y como también sabrán, a lo largo del año nosotros pasamos por una ruta Value y en agosto tuvimos también un parón, pero en septiembre volvemos con un tema que creo que interesa a muchísimos, que es la evaluación de empresas. ¿De acuerdo? Entonces pueden visitar nuestra página web www.valueschool.es y ahí pueden revisar todas las entradas nuevas en nuestro blog referidos a este tema, nuevo contenido también que estamos desarrollando para el canal de YouTube y también un podcast muy especial que sé que les va a gustar a muchos y nuestros nuevos eventos. Además también, hablando de novedades, antes de despedirnos de nuestras vacaciones, antes de verano, presentamos estos juegos de mesa que son parte de nuestra iniciativa de Value Kids. A ver si me caben todos en las manos, porque además que son grandotes. V-Value, Play Value y Value Memory. Claro, tuvimos unos pequeños problemas y se ha retrasado el lanzamiento, pero está ya muy cerca. Os agradecemos muchísimo a todos el interés y pues por lo menos debíamos una explicación para que supieseis también por qué no se han comercializado de momento, pero la espera está llegando a su fin y pronto vais a poder disfrutar en casa de estos maravillosos juegos, tanto pequeños como mayores. También otra vuelta a las vacaciones en Tu dinero nunca duerme, el primer programa sobre finanzas e inversión de la radio generalista en España. Participamos semanalmente en él también con la colaboración la participación de Luis Fernando Quintero, Manuel Llamas, Domingo Soriano y siempre un invitado especial del mundo de la inversión o un especialista en el tema que tratemos cada semana. De momento ya hemos hecho 2 programas desde la vuelta de verano en lo que llamamos de septiembre y este domingo a las 2 pueden seguirlo a través de radio con un invitado muy especial del mundo Value que seguro que les suena y que les va a gustar también mucho. Y por último, un anuncio especial, también esto es parte de una novedad en Value School, y es el lanzamiento del libro, que además, oficialmente empieza la venta mañana, día 19, es la traducción de Dando Investor, de Monish Pabrai, lo tenemos ya ahora al español. Una obra que de verdad, si no han leído, totalmente recomendable, tiene unos capítulos buenísimos tratando el tema del riesgo, la incertidumbre, el sizing de las posiciones, por así decirlo, en cartera, muy interesante y ya digo, a partir de mañana ya pueden comprarlo. Por cierto también, que se me olvidaba, este libro también es muy especial por otro motivo y es porque es el primero de nuestra colección que incluye ya los agradecimientos a nuestros simpatizantes Buffett y Munger en las primeras páginas, así que aprovechamos también para mandarles un fuerte abrazo a ellos y también a nuestros simpatizantes Lynch y Graham, y os animamos también a todos a que descubráis un poco las ventajas que ofrece nuestro programa de simpatizantes. Y dicho todo esto, creo que ya vamos a cambiar al inglés y a empezar con Peter. Peter Smith, ladies and gentlemen, thank you very much, Peter, for being here. First, let me introduce you, and today we're going to talk about Peter as an investor and his new venture, which is Palm Harbour Capital and the fund and how he managed it. But first, as I said, let me do a brief introduction of Peter. Peter Smith, he's CFA, is the portfolio manager of COBAS SICAV Palm Harbour Global Value Fund and managing partner of Palm Harbour Capital LLP. Before founding Palm Harbour Capital, Peter worked closely for over 2 years with Francisco García Paramés. Peter has extensive experience analyzing and investing in companies. He graduated Magna Cum Laude from Texas Tech University with a BBA in international business with a focus on finance and German. And he also has a master's in finance with a focus on investment management from London Business School. And well, as I've said, I don't want to say more about you, Peter, and about Palm Harbour, because I know it's better for you to tell us about it, but I know a little bit about your story, so correct me if I'm wrong with this question, but please explain to the audience how an American guy based in London happens to meet Francisco García Paramés, then works in Madrid, and now he's here in Value School presenting his new fund.
Yeah,
it's quite an intricate story, yeah?
Yeah, okay. Well, I guess to go briefly on my history, I guess. I first got interested in both Europe and finance in high school. I took a European history class, and yeah, just kind of fell in love with the history of all of the countries, and said, gosh, I'm sitting here in Texas, I'd really like to go see that. And at the time, and so I took that, and then I also had an economics class in which I learned about compound interest, and that was during the roaring late 90s, and everybody was very excited about tech stocks and everything. So the professor talked a lot about equity investing, and then you get compound interest. You're like, oh, this is really interesting. And then at the time, I was playing an online role-playing game called Ultima Online, in which I was buying and selling property, virtual property in the game for real money, selling stuff on eBay to people who didn't have the time to play. And so I had a bit of savings, and so before I went to university, I backpacked in the summer around Europe, and went through Germany and Spain, and I was like, wow, this is amazing, all different cultures and architecture and meeting all the different people, and I just fell in love with Europe. And so when I went back to Texas, I originally said I'm going to do a history degree, in which my mother, who's a forensic accountant, basically said, that's the dumbest idea I've ever heard. You'll never get a job doing anything. In which I was like, I can be a history professor or something. And she's like, please take a finance class. Just take an intro class, and if you don't like it, I'll never ask you again. And of course, I took an intro to finance class, and I was like, oh, this is what I want to do in my life. So I basically wanted to do international business and finance so that I can go, travel to Europe, and then I can also do finance. And so I did a study abroad in Germany for a year, learned German, worked on Spanish, took a Russian class, and basically when I was graduating, I knew I wanted to be in finance, and I knew I wanted to be. I don't think if I knew exactly what equities was what I wanted to be at the time, but I knew I wanted to be, investing. And I applied to everything I possibly could, mostly in Germany, and I got a job at a German bank. And while I was there in Frankfurt for about a year, and I realized, well, if you're going to be in, well, at least pre-Brexit, if you want to be in finance in Europe, London's the place to be. So I managed to transfer myself to the equity desk in London, and that's where I really began to start understanding about getting deep dive into companies, and I met tons and tons of different funds, and saw all the different styles of investing out there, and I started reading a lot of books, started working on the CFA, and then I saw kind of the differences of styles where, you had the prop traders who were just, day trading stuff, and you had long-term fundamental people, and you had everything in between, and quants and everything. That's when I read, Benjamin Graham, and that's when I started reading Warren Buffett, and that's when I was like, this makes a lot of sense to me. And then I really wanted to go to be on the buy side, because I would be working on ideas on the sell side, and you kind of talk to people about it, but then you have no responsibility. You don't know if they did it or they didn't do it, or they think your idea is great or not. It's just kind of, you're just saying things. And so I was like, I want to have responsibility for my ideas, and I want to be the one who does the work and then has the outcome. And so I found it frustrating. Of course, then I wanted to move, and of course that was in the middle of the financial crisis. So weren't lots of buy-side jobs being about. So I stuck to it, got the CFA, did everything I possibly could, and then as a year or two, I was like, okay, I really need to make this transition. And I found the best way to do that was to go through business school. That seemed to be what all the advice of all the guys on the buy side were telling me, that make it easier for them to hire me if I got an MBA and whatnot. So I looked around, and I basically determined that you had Columbia with a value program, and you had London Business School that had a well-known value investing class. And as I was doing European stuff, and I was concentrating on European equities, and I was doing everything in Europe, I was like, okay, London Business School, that sounds perfect. And so I went and did the Master's in Finance there. And while I was there, I took a class taught by Eddie Ramsden, who he himself got the MBA at Columbia Business School, and he was taught by Joel Greenblatt, he's a well-known value investor with an amazing track record. And I took his class, and that's when I really understood like how much work needs to be done, and how important like real due diligence is, and what kind of stuff people do to really understand companies, and go to trade fairs and go talk to as many people as you can and try to understand everything you can and try to really get a holistic view of businesses. And while I was there, Eddie told his story of how Joel Greenblatt seeded him into business, and I was like, wow, that's like the most amazing thing I've ever heard in my life. Like you were able to start your own portfolio and your own individual business out of it. And given my personality, and like as I said, I wanted the responsibility, and just my personality fit just went to like that's what I wanted to do. And so then I went and I tried. I was talking to everybody I possibly could, family offices, and just saying, please, what can you do? And I had a colleague at London Business School, and I think he saw in me my passion and my and how much this meant to me, and how much I think he was good at it. And he said, hey, I happen to know a guy. His name is Francisco García Paramés. And I'm like, what? You know Francisco García Paramés, like one of the most famous value investors in Europe. And he's like, yeah. He's like, maybe I can get a meeting with him. And so he arranged a meeting for us to go and meet him. And we went, and we went up to him. We had a presentation, and we basically walked into the Bessemer office in London and said, Mr. Paramés, we'd like you to give us 10 million to start our own fund with. And he's like, who are you? And so we started talking about, pitched some ideas. So I pitched to him MTU Aerospace, a company listed in Germany, and I pitched to him Prime Office REIT, another German company. And then we started talking, and then he was kind of, he entertained us, and an absolute gentleman. And then, we left, and we were like, let's see how that went. And then later we got an email and basically said, I'm actually going to leave Bessemer, and I have a non-compete. I can't be involved in anything. So and then nice meeting you. I'm like, so eventually I had to go get a real job and not pursue my dream as actively. So I went to work for a fund, and I actually ran into Paramés again at an investing conference, and I was like, can I have your email address? And I was like, And he was reluctantly, he was like, oh yeah, you're the crazy guy who asked me for lots of money. And then he gave me his email address, and then I started sending him investment ideas. Every 2 or 3 months, I would write up a long investment pitch and email to him, and didn't really get any replies or anything. But then when he started setting up COBAS, he sent me an email and said, hey, could you come to Madrid, like on Thursday? And it was like Tuesday or something. I was like, yeah, okay, sure. So I'm sick, going to Madrid. So I came to Madrid and met him, and he was like, oh, would you like to be my analyst and work with me? Like, your ideas have been fantastic, a lot of them, everything went up, and it was just, whether it was skill or luck, it was mostly luck, I think. But and he said, yeah, I think you would be a good, come and give it a try and be an analyst. And I basically looked at him and I was like, I don't want to be an analyst. I met you 3 years ago and wanted to start my own fund. And then he was like, okay, well, why don't you come, work for me for a bit and get to know me and see, if we have a relationship and if it, makes sense. And so I did, and while I was here at COBAS, I was running a model portfolio for him and showed him all my ideas, and this is what I would be doing if I had my own fund right now. Look at these great ideas. And then after wearing him down continuously, he said, okay, why don't we give it a try? So that's how I ended up coming from Texas to London to Madrid to starting a fund. Sorry, that's kind of long-winded, but there you go.
So the next step was Palm Harbour after all of this story that you just told us. When did you start actually Palm Harbour? It was recent, right? Well,
we launched the fund in April of this year, but we started Palm Harbour a year before that. It takes quite a long time to FCA and then go through the Luxembourg regulation. There's Brexit worries and all sorts of stuff that happened in between.
So can you tell us a little bit more about the project, like the team, the partners behind the project?
Sure. Well, the partners are Paramés and myself. He's not active in the business. He's a silent partner, so he just looks over my shoulder and makes sure, but otherwise, he's not doing anywhere in the day-to-day. So I'm the portfolio manager and I run the company. And then I have one analyst working for me, Thomas Livesey. He's also an LBS MIF value program alumnus. He as I guess I did with Paramés, he aggressively was trying to break into value investing. And because business school is kind of about the alumni network, I always say yes to students who ask for like a coffee and stuff. And so I invited him in. He was clearly had the passion. He walked the walk, talked the talk. He knew all the books. He knew everything. And I'd met so many people who just kind of said that, and I think they were like, "Oh, I'm in business school. I should like try to find something interesting." And doesn't that sound great? Warren Buffett something. But he clearly was like kind of dedicated to it, and so I took him on as an intern, and we worked together for a bit, and then I hired him full time when he graduated. Mm-hmm. And so it's been like about 2.5 years that he's worked with me.
Okay, so you've mentioned already a couple of times the term value investing, which is, well, as the term has become more and more popular, there are also like very big discrepancies about what value investing exactly is. So I just want to ask you, like, what is it to you? And first, does it really exist, like something like value investing? And what it is to you?
That's a good question, because everybody theoretically is a value investor, I guess. You're trying to find value in investing, I don't know. But to me, I would say, what's intelligent, what's sensible. And what's intelligent and sensible is different to everybody. But to me, it's thinking like a long-term owner, thinking with a long time horizon, trying to find high-quality businesses, which means high returns on capital, good steady market shares, good margins, being able to have competitive advantages that you can identify. You can understand why the biggest threat is new entrants, and why can somebody not replicate this business. So I always think, if I had unlimited capital, kind of how difficult it would be for me to replicate the business. And then you want to be able to buy these businesses and be able to understand the future cash flows and how predictable are they. And then you want to buy them when they're trading at a substantial discount to what you think that discount of normalized, through a cycle cash flow generation of the business is. And then you want to buy it at a fairly substantial discount because, well, you can be horribly wrong about all your assumptions that you're making. So I think it sounds very simple, but it's almost it's very difficult to implement properly. Like you have there's so many human biases. There's so many, even computers can't do it properly for other reasons we can get into later. But it's very difficult to execute. And so you have to have the right mentality and the right thought process and the right diligence to be able to do it. And I think it's important, like you said, there's tons of people who say word value, and you read in the newspapers all the academics and the indices. They're like value. That just means you're buying something at a low multiple price to book or a low multiple price to earnings. And that's not necessarily value. You could be buying a company at 10 times earnings, but it's in a declining industry that is, product is going obsolete, or the competitions come and change the game, and margins are being eroded away, and that 10 is horribly expensive, and it should be trading at 5, or something. And at this other end, you could be having companies trading, at 30 times earnings, but they're growing, and you understand the cash flows, you understand the business model, and actually that 30 is dropping to 10 in 2 years' time, and it's actually a great bargain to be buying it today. So. It's not, the statistics don't make sense. As Warren Buffett said, growth and value are hand in hand. And it's more difficult the more growth you have to understand sometimes. A lot of high-growing companies are very new, so they're much more difficult to understand what the future cash flow potential is. So there's tons of now SaaS, software as a service companies, which are trading at 100 times price to sales, and they're growing at 50, 100% a year or something, but they're horribly loss-making, a lot of them. And you're basically making an assumption about what the TAM, the total addressable market is, and then you're basically saying, in 10 years they're going to, it's a $100 billion market, they're going to have 10% share, and their margin should be 30%. And even though they're losing hundreds of millions today, if we kind of discount all that back, it's a great bargain. But like to me, there's so many assumptions in trying to understand if that growth rate continues and why new entrants couldn't come and see that this is a great business if they ever do achieve really high margins, and why it's not going to be competed away. And because it's so far in the future, so many things could change in that time frame, I'd just prefer to buy a company that I understand the cash flows today and understand the competition and is producing cash, and I can have a much better chance of being able to value it. But then on the other hand, you do have those kind of companies. You have the Nestle's and Diageo's of the world, which are that, but they're trading at 30 times multiples as well, but they're only growing at like 5%. And if you're growing at 5% with a 30 multiple, I mean, think about it, just get your earnings back, it'd take 19 years. I mean, that's a fairly long time just to get today's earnings in the market cap, right? So I would rather buy that 5% grower at 10 times earnings, where then you're getting it back in like 9 years, which is a much more reasonable time frame to me than 19, if I had to make the choice between the two. So yeah, and then you have people who think their value is also much more. There's value in things that don't produce cash, right? Speculation, Seth Klarman would put it, right? Where I'm investing in artwork. Well, I mean, how are you investing in artwork, or in luxury cars, or in all these kind of things? And they're like, yeah, but I'm buying wine. But these things are all just based on people's tastes and opinions. It's not cash. And so your taste and opinion is different from mine. So you might have more money, so you pay a higher price for it than I do. But I mean, it's impossible to. So things that have value are things that are investing and not speculating, or things that are producing cash that you can actually have some chance of measuring that cash and bringing it back to today. And then the value part is not just doing that part, but then buying it when it's trading at a discount to that, when the market doesn't see that, and that's a difficult part. Because most of these really great companies that can have these perfect cash streams trade at the price they should, or close to, or above it, and especially today with very low interest rates.
Okay, great. Now that we know a little bit more about how you understand value investing, or intelligent investing in this case, please tell us a little bit more about details of how you apply the philosophy in terms of, I don't know, for example, sizing of your portfolio, cash. How do you manage that? Also, do you have any kind of boundaries, or what's your kind of focus? Where do you look for ideas in terms of, do you have any geographical bias, industry bias, maybe something a little bit more complex regarding business models?
So like portfolio construction, I guess.
We can go through all the different points.
Yeah. So there's always the arguments. Do you want to own thousands of things, and then if anything blows up or goes really high, it's a very small thing, or you're closet indexing or hugging benchmarks and that kind of thing, or you're running a very concentrated portfolio. And I guess I'm somewhere in the middle. I like to have like kind of somewhere between 20 and 30 ideas, where you have a few concentrated names, and then you have a kind of a tail of things that you're either kind of still working on and building up to, or that you're exiting from, or things that are just too risky that you don't want to make a gigantic position in, but is still very intriguing as an investment case. And then as far as cash, cash is something that's usually high quality businesses trading at a larger discount's better than having cash most of the time. I mean, there's always the financial crisis that occurred that were, I wish I would have had cash. I could buy these regular companies at even bigger discounts. But I try not to, you want to have some cash because there's always something going down that you want to buy. But at the same time, you don't want to have a lot of cash. So I don't know. I don't really put it too much into my process. I just kind of see where my ideas are and where I'm entering and exiting, and how fast I'm entering and exiting. And I don't want it to be very high, but I'm also not. It's not something that I think of a lot about, to be honest. And then as far as geographic, it's a global fund, heavily skewed towards Europe because that's where my background is. Some U.S. positions, and we're building knowledge at the moment in more Asia. But to be honest, that's the least important thing. It's finding the high quality companies and doing the things, finding the right investments. And so where they are located, that's not really that important to me. But I guess we can talk about search strategy at some point and discuss how we come up with ideas to begin with. And then kind of finding the most important thing, though, the risk management is position sizing, and really trying to understand what you're exposed to. And so what you're exposed to is like a lot of people can have a portfolio of ideas, but maybe you're just playing on one theme. Like you just have all these things, and it's all just this is kind of you're just playing on low interest rates or China growth or something. This is all consumer things, and so we want to find a wide variety of kind of drivers that are driving the particular investments that are, everything's. I don't think about the top down at all, but you do want to make sure that when you find individual businesses that are interesting, that they're all not kind of exposed to the same things, that you have a wide variety of ideas or exposures. And then the most important thing for risk management and for building the portfolio is position sizing. And the two most important things with that are both it's operational leverage and financial leverage. So financial leverage, I think, is easier to understand because it's basically when you have debt, you're magnifying your exposure to the operating business. So the more the operating business goes up or down, the financial leverage is basically driving how exposed you are. So if you say I want 3% exposure to the business, well, if it's levered, maybe you want to be 2% position in the fund because you can create that 3% exposure to the business through that. And so you always want to make sure that the more financial leverage it is, the smaller position it is. I mean, it's very simple. And if it's like net cash, the more net cash it is, the larger it needs to be to offset that to make it more exposure to the operating business, assuming that's what you're doing. And then operating leverage is the second most important thing. When sales go down 20%, does your margin go from 14 to 12? Usually, a lot of variable costs and a small fixed cost base, or does your margin go from 14 to negative 14 and you start burning cash immediately? Because how that operates makes a huge difference in what position size you want to be. So those are the two most important things. It's just basically finding what's actually exposure to the business and what are the chances of this, a loss occurring. Because, I guess another thing about value investing is, the market's giving you not what the value of the company is, it's giving you whatever the mood of the market is. And so when you are, what you want to be doing is like academically, risk equals volatility. So the more volatile something is that goes up and down, that's more risky. And I would say that's, what's risk is what is the ability, what is the permanent capital loss, right? When is it actually this company, lost a factory, it's now destroyed, doesn't have insurance, that's now, they've lost that money. They have financial leverage, or, they go bust. I mean, when they, spent tons of money on R&D and then the product turns out to be, nobody likes it and wants it or it's not necessary and you just wasted all this capital on the R&D. I mean, those are like permanent losses of the company's capital, whereas the stock market goes up and down, it's not. And so you have to spend your time trying to figure out, trying to think about if something bad happens, how bad could it get and how much cash can they lose, and if, and put that into kind of your mindset of like, you can own things like, I don't know, an oil field in Iraq, it might be a zero at some point, right? So that could be easily, you can see that it'd be a permanent capital loss at
Peter,
some point.
do you own an oil field in Iraq?
I do, yes. But it's not a 10% position in the fund. And they also own Norwegian assets and other things, which is part of the company. But yeah, you have to put that into your factoring of like, bad stuff could happen there. It's perfectly easily imaginable. So yeah, that's what you're more concerned about, like position sizing and putting a number of portfolio positions.
Well, I've asked you about the oil field, but we can also talk about more positions in your portfolio. So first, please tell us a little bit of how, because you've talked about themes. So how do you classify all of your positions in your portfolio? Do you do it by, I don't know, like themes, or what kind of business model they operate under, or?
Yeah, I mean, I guess kind of. That's so strange. I guess high level, there's different kinds of value investing as well. I mean, the main thing you're looking for is looking for these high quality compounders that you're trying to buy at a discount. So, like the MTU jet engine maker that's just has beautiful long-term cash flows. You should understand in buying it when the market thinks it's a terrible idea. And then there's also things like asset plays. We also own a hotel company that has 7 hotels on the island of Barbados, and the company trades at half the value of the property. And they produce lots of cash, and yes, it's a perfectly good business, but it's not exactly a growing business that's going to. I mean, you can't build hotels anymore in Barbados. There's no more prime beach left, and so it's not going to magically triple its cash flows unless they can reposition the hotel somehow. But it's trading at half the value of the property, so at some point somebody's got to say like, well, let's just spin off the properties into a REIT, even though it's quite small, so it's not going to happen, or Melia or somebody who Sandals should buy it and take the money, extract the capital from property. So that's more of an asset play type thing than having we're buying this long run thing. So they have those kind of buckets. But I think most importantly, I try to think about them as kind of, what's having different kinds of, it's more about just the exposures, just trying to say, I have the compounders, I have some of the assets, or I have some special sits, spin-offs and these kind of things, which are more short-term kind of things than having the long-term compounders. But then I spend more time thinking about business models and try. So you want to have, what kind of business models are you exposed to, and how fragile are some of the business models? It's like the oil company is, oil prices can do things, and you can sit there and look at cost curves all day. But I mean, sometimes Saudi gets attacked, and oil prices don't do what you think they're going to do. I mean, so you don't want to be very big in things where they're not masters of their own destiny. You want to be bigger in things where people can actually influence what their outcome is. And so it's more about analyzing, just spending all your time analyzing the business model.
And also, could you take us through one of your best investments and what lessons did you learn from it?
I mean, you want like a current idea or something historically?
Historically, yeah.
Okay, well, I like to talk about MTU since that's the one that I pitched to Paco first, and that probably got me to where I am today. Basically, you had this aircraft engine company that was basically, to make an aircraft engine, it takes billions of dollars, and you build them, the engine, and you then sell them at a loss, and then you collect the money over the next 30 years. And it's the most safety critical piece of an aircraft. And so nobody just goes and be like, oh, I'm going to go buy, this guy. He just came up yesterday. I met him on the street, and he is offering me an aircraft engine. I'm going to put it on this commercial plane. He's like, you just don't do that. So it's basically, you have 4 players, and they're all kind of duopolistic kind of markets in wide body and short body. But they basically went through some short-term headwinds because, one, the Department of Defense was coming out of Iraq, and so a lot of the planes they were flying, they took out of service, and they said maintenance was happening. And then they also got introduced into all these new platforms for all the new Boeings and new Airbuses, and so they were spending lots of money on R&D, and they were spending lots of money selling all these new engines, and so they were creating losses or very low margins, and the market was just, they had a profit warning because of the DoD, and the market just sold it off heavily, and you're just like, yeah, but in 5 years, when all these new engines go into serviced, like they're making 40-50% or even higher margins in all this. And so you can just take the short-termism of the market who's concerned about the next quarterly earnings and say, I'm going to do time horizon arbitrage, and just say I'm willing to sit here and wait, and it exactly worked out that way, and it's been catering at 30% per year since then. And I guess what I learned there is that it was an idea that I've pitched to lots of people. I even did like an LBS presentation in front of all the professional investors and stuff, and they just tore my idea apart and said it was terrible. And then you guys sit there and just be like, well, okay, you have to have the conviction in your own work to be able to say, okay, screw all those guys, like, this is a great idea, I'm going to put some money into it, and I'm going to still go talk to everybody about it even though nobody listens to me. And so I guess if you do your own work, then you can have the confidence to go against everybody else who's telling you that you're wrong, and it's super cyclical, and you're missing everything, and then you just say, okay, well, why is it? And then you'll be like, yeah. They're like, it went down in the financial crisis. Yeah, it's like, well, the stock price went down, but look at the cash flows and the earnings and the margins. They didn't move at all. Like, just because the stock went down, that's not an argument for this thing being super cyclical. That's an argument for that people panicked in the financial crisis where they were highly levered and had to sell stuff. I mean, it had nothing to do with the fundamentals of this business. So learning to go have everybody disagree with you and still stand by it, I guess, is the thing I learned.
Right after my question, you asked me if I meant like historically or a position that you might have now. I don't know if you want to talk to us about maybe one of your biggest positions in your fund, and also talk about that idea and what are you learning with that? How's it going?
Sure. So the largest position in the fund right now is a company called Westinghouse Air Brakes, or Wabtec. It is quite interesting company at the moment because basically it just did a large spin merger transaction with GE. So GE had a train business where they were selling locomotives in the freight business, And if anybody knows anything about GE right now, they have a very stretched balance sheet and need cash. And so originally they were structuring this as a spinoff to GE shareholders, but they basically ended up saying, we're going to take GE took the majority of the stock. And so they merged their train business with Wabtec's business, and so GE and its shareholders ended up with about a 50% stake in the business. And then over the last few months, they've been dumping it in the market, and they actually just exited like about a month ago, which produced a very interesting opportunity to enter into a high-quality business. As the deal was announced a year ago, the stock was trading at $110 a share, and in mid-August it was trading at $60 a share. And what makes the underlying business quite interesting is that Wabtec produces brakes. The main product is brakes for trains, and this is the same thing as the aircraft engine. This is a safety-critical component. You don't go to the Chinese manufacturer that got set up yesterday and be like, yeah, can I save 5% by buying some Chinese brakes? And then you run your train and there's an accident, and then you're never going to see your job ever again, or So nobody makes that decision to do that. So you stick with basically the two suppliers worldwide. One's called Conora Bremse, which recently listed in Germany, and the other one's Wabtec. And so, fantastic business as far as that's concerned. So we basically had GE come in, and you had them dumping stock. And then there's another concern, which is called precision scheduled railroading. And precision scheduled railroading is a big deal or is what we've talked about heavily, but I mean, I talked to tons of experts. I mean, the basic concept behind it is if you run trains on time, then you don't have locomotives sitting around doing nothing, which makes sense. You should, run to schedule. But when you're doing like freight railroads, especially like in the U.S., things don't run to schedule. Shipments are late, people are late, crews, things happen, and so they're always running suboptimal. So there's this guy, a Canadian CEO, Hunter Harrison, and he came up with this precision scheduled railroading, and basically it was to, it's all about the margin, forget the customer, forget running, the train runs on time, it gets to where it is. And so if this happens, then there'll be less trains running in theory, but that's not true. Actually, you're going to be running more trains, and you're going to be running them on a schedule. There should be shorter trains, and shorter trains, the thing is, then you have a lot less locomotives, so you add for GE's business. But actually, you might have some less locomotives, but most trains still have to have two locomotives, because if the locomotive breaks down, you're on a track that you can't get the train off of, so you always have two in case one breaks down. And if you're worried that, okay, but maybe we're just going to do more maintenance so that the train doesn't break down, if everything's always up to speed, again, that'd be great for Wabtec, because they do the maintenance and servicing of the train and the brakes and the locomotive. So no matter how I look at it, this just looks like a net positive for the company, but the market seems to be concerned that it's a net negative. So between GE selling a bunch of stock and the people worried about that, it provides an opportunity to basically buy this company at a just ridiculously low valuation. I mean, it's trading at like half the multiple of its closest competitor, and it's trading at like a 12% free cash flow yield on next year, which I think is ludicrous for such a high quality business. And then you can be like, oh, but the U.S. might be slowing down. And it's like, well, half the businesses, or a third, 40% of the businesses, the transit business, which is all government sales to government entities. So that's, I don't know. It seems like there's a very interesting dynamics going on, and we're very excited about it.
It's a similar idea also to, as you said before, MTU. I'm sorry, I wasn't remembering the name. In terms of how the product is, and being something really critical. And
well, one thing when you I guess you learn in or what you experience tells you is when you see something that's similar, like you see business models where there's a thing that you sell here, and you get the maintenance and service at high margins, and this is a niche safety critical thing that's a small cost of the overall end product, but it's absolutely necessary. So they have pricing power. When you're looking for ideas, you see this business and you're just like, well, it smells good. Like, this is interesting, right? And on the flip side, you see businesses where you look at the business model and you can just immediately say, I'm not interested, right? There's tons of businesses that I would dismiss almost offhand. Maybe I shouldn't, but there's banks which you look at you don't understand what who they're lending to, what they're doing, highly levered, and it's a black box, and I just don't understand it, so I can't possibly try to invest in that. Or you have a lot of engineering construction firms which have gigantic backlogs, and they have billion-dollar projects, and they make 4% EBITDA margins, and then they're like, oh yeah, that was really competitive, and by the way, we kind of screwed up on our pricing, and we're running over by 20%, and there goes the next 2 years margin is gone, and and you just see those blow up all the time. Or you see, we have that key man risk. If you have a couple of people who are really good, either they walk away and start their own firm and compete against you, or they know, gosh, I made $100 million last year for this company, I should get a huge chunk of that, and they know what they're worth. So having this asset-light model, but where there's all these key people that know what they're worth, and it can walk away. I mean, you just immediately look at that and you're like, there's no he can walk away and start the company again, then you immediately have a threat of new entrants, and there's no competitive advantage that's going on there. So so there's lots of business models which you can just look at and be like, I've seen that before, that looks interesting, and I've seen that before, and it looks cheap, it looks everything's there, but the business model I can just see that blowing up or something. So, and you just get that through looking at business model after business model after business model after business model and seeing that. And so yes, a lot of things you kind of do look similar to past investments, because you found something that works, and you kind of say, this, I see these dynamics playing out, and I see what their competitive advantage is, and then you can say. That being said, no two things are exactly the same. There's always different risks and stuff. So it's don't get overconfident with it either. You have to do all the work and do everything and make sure you understand what's going on.
Yeah, but it's true. It's really interesting, because once you have a big success, you can try to learn from it and then try to replicate it to have another success. But also, let's talk about trying to avoid mistakes with lessons from past mistakes. Could you take us through like some of the lessons that you've learned from past mistakes?
Yeah, I mean, I think going back to like the position sizing and why you want to avoid certain things. I mean, companies with a lot of leverage that have problems. So a lot of things that you look for, like things that are going through short-term problems. So a lot of my time is spent, is this a short-term problem, or is this a structural problem, or is this disruption destroying things, or is this just the market worrying about the next quarter or two? But then sometimes you find these turnaround cases, and we are like, okay, we have a new management team coming in, or we have something like, this is going to get better, even though it doesn't look very pretty at the moment, but this is going to get a lot better. If I just normalize everything out in a few years, this is going to be fine. But if you kind of have a turnaround, I guess I've learned that turnarounds sometimes don't turn around, and sometimes they turn around, but it takes a lot longer than you think. And so when you put debt on a turnaround, I've learned that that's not always the best maneuver, because sometimes you look at it and you're like, this will be fine, in 2 years we'll get to normalized margins, and maybe that 2 years is actually 5 years. And if you have debt in between there that you need to refinance or something, that's a recipe for disaster. So yeah, I would say avoiding turnarounds with debt are definitely something that I've learned not to get involved with.
Okay, we're gonna go now. We're gonna prepare for the Q&A part of the event. But in the meanwhile, what you can do here in the main room, you can just raise your hand, and my colleague Irene will pass around the mic for you to make your questions. And in the meantime, please just raise your hands if you have any questions. And whichever wants to go first. I'm gonna ask Peter first another question, which is what have been the greatest influences in your investing philosophy? This can be just like colleagues or great investors, as I think you mentioned the book that got you into value investing. So,
biggest influences. Okay. Well, the thing is, I guess there's no one big influence. I mean, obviously, you have to read the core books, but getting into it and then improving as an investor, I guess are two different things. The core books you have to read. Joel Greenblatt's You Can Be a Stock Market Genius. You have to read Seth Klarman's Margin of Safety for the philosophy. You have to read Competition Demystified by Bruce Greenwald, and those influenced me a lot. Eddie's class, as I said, at London Business School, huge impact on really understanding how much due diligence needs to be done and how to actually do proper work and far beyond what you get in the sell side and that kind of thing. I mean, obviously, Paramés has been a huge factor in the last few years, mentoring and influencing how I think. But to be honest, I guess the biggest things, are just is all the small things. Like, I mean, all these things contribute, but actually working and meeting all these different kind of investors and just seeing how not to do things
Yeah.
and how I don't want to do things is probably the biggest influence. And so if you look at all the people I worked for before, or all the people a lot of people I've met and I've talked to, and I just see what I don't want to do. And I think that's probably the biggest influence is like, I've seen this before, like, you see people, heavily influenced on their emotions. They're happy one day, sad the next day, and they're, let's buy everything, let's sell everything, let's trade, let's do this. And they, it's like, okay, I don't want to do that. I want to be, stay as unemotional as possible, go through your investment process, your checklist. And so I think I'd say avoiding certain behaviors is the most, what influenced me the most.
That's very in line with Charlie Munger's idea of you don't have to try to do intelligent things. You just happen to do intelligent things by avoiding dumb things, basically.
Yeah.
Yes, we can go with the first question.
Thank you, Peter. Very interesting. Basically, how can we invest in your fund then?
How I can invest in the fund?
Yeah.
Well, here in Spain, we're on like the major platforms called All Funds and Inversis, and through them, basically all the banks and brokers can theoretically execute trades or it can invest. I don't think we're on any particular lists that, so I think you'd have to actively ask them to do so. I think the only ones where there is like a pre-approved list is Renta 4, I believe recently, and BBVA Net we're going to start with the relationship with, I think, in a month or so. But otherwise you have to go and actively ask and push people, so it's not the easiest thing in Spain to do. In the UK, it's the same thing. The AJ Bell were on their platform, but all the other platforms you'd have to physically go and ask. So it's really set up now for larger family offices who can do it through like a Swiss bank and stuff. It's the easiest because the fund is based in Luxembourg, so it's with Pictet, and so you can go directly with them, or otherwise you have to ask. But good question, thank you.
Yes, we have another question here in the room.
Well, thank you, Peter, for your fascinating story. What's your opinion about the current situation? There's a huge decoupling between the value, whatever, how is that defined, versus growth. There's a huge valuation gap between the two styles, whatever you want to put in those two. You think we are in front of the best opportunity of our lives? I mean, in the last kind of years, I mean, value, generally speaking, hasn't worked out too well. What do you think? You think investors have lost their mind? What's going on?
Yeah, investors losing their mind. Yes, I mean, there was a great chart, I wish I brought it to now, basically showing, the value versus, again, not how I would define value and growth. And actually, I think you can even throw momentum on there as the other factor that you should, growth momentum, because momentum is actually more important than growth is in this case. But the skew, and it's basically the same as it was in 1999, 2000 at the top of the tech bubble, where value is absolutely hated and momentum/growth is and it's at the same kind of level. And if you look at like recent IPOs, you can see the same thing. You just have these cash burning companies, and you see the Ubers and Lyfts, and where we work at the moment in London, and and this is a business that has no competitive advantage at all. Like you and I can walk down the street and buy, rent a 15-year lease on an office and then sublet to a bunch of people for 1 month. That doesn't make it, it's zero barrier to entry business, and they're trying to sit there and be like, oh yeah, we're 47 billion. I mean, that's just nonsensical, right? So I think, but now we work, on Tuesday got pulled, and so now maybe in Uber and Lyft and Tesla and all these companies are starting to, investors are being like, oh, maybe it's not the greatest idea to give unlimited capital to a bunch of cash burning companies that trade at ridiculous valuations. Whether, that then means we're start buying companies that are producing tons of cash and buying back their shares and are running good businesses and value them higher. I mean, that's more difficult to say, but I would say that we probably are closer towards that, and I guess what's going to happen, is we're going to have some sort of recession or some sort of global slowdown, and people, all these things that we're growing, and people are going to be like, oh shit, maybe we should be paying 100 times for that, but these companies are actually, have tons of cash, producing lots of cash, and I think in a down part of the cycle, we're going to start seeing that switch, and then people are going to, and then what's going to happen again is, you throw that all away, like all the hypes and fads, the cannabis stocks and all that kind of stuff. Everybody forgets about them. They've lost tons of money, and then the next cycle begins. We all go back to the high quality compounding companies. We bid them up to more normalized levels, and then we get excited about the next thing, the next hyped up stocks, and everybody starts piling into them, and then everybody forgets about the other companies, and then we have some slowdown. The fad stocks momentum falls, and we go back to buying the high quality stuff, and it just goes through cycles. And so, long answer to your very short question is it might be the best time ever to buy values.
Okay, so we'll have time for one or two more questions here in the room, but I'm going to ask you something, Peter, that's coming from our online audience, and they're asking about just generally your portfolio and some other positions that you might have. So first, can you tell us a little bit about how concentrated is the fund, and in your, for example, the first 5 or 10 positions, and can you take us through some of these ideas very briefly?
Sure. So at the moment we have 22 positions, of which the top 5 is probably 45% of the fund or so. So yeah, like I said earlier, the largest is Wabtec, and then we have a company called GameNet, which is an Italian gambling concessionaire, and basically they've banned advertising in Italy, and I think that helps this company. So the market says, oh, that's terrible. But actually, when you ban advertising, it means the incumbents who have physical locations in the country have an advantage because they can kind of soft market, whereas if you're just like an online startup, or you have no way of reaching the audience. And they just produce tons of cash. I mean, it's just a very great company, and they're limited by government permits, so there's only 7 of them that are allowed, and they all have their kind of carved out market share niches, and so they basically are able to earn outsized returns. And so they had earnings just like 6 weeks ago, and it's like this thing was trading on a 10% dividend yield with a 2% share buyback they were doing, and was paying down what little debt they had very rapidly. And you're just like, well, this is, the market cap was quite small. It was like 250 million market cap, and they made 50 million cash in the first half of this year. So if they just, it's just ridiculous. Another company is the hotel company I was saying in Barbados. Another is a fertilizer company called OCI, which most people would be like, oh, fertilizer, that sounds like a commodity. That's not great. But they're cost advantaged by being in excellent locations. And so they built a new plant in the middle of the U.S. Corn Belt, where nitrogen fertilizers are one of the most used places. And they have very cheap gas in the U.S., and so nobody can really compete with them on cost or location. So they immediately have a huge premium. And nobody in their right mind would build a new plant today, because the build cost versus the prices just don't make any sense whatsoever. And then they also have plants in North Africa, where they also have very, very low gas prices, and they're able to sell it into Europe tariff-free. So they basically, while it's a commodity company, they have the lowest cost on the cost curve, and then it's owned by it's 50% or over 50% owned by an Egyptian billionaire who. His father built up the cement empire, and they sold it to Lafarge at the top of the cycle in 2007. And every time you talk to him or interact, this guy's thinking about capital allocation, and he's thinking about investing, and he's thinking about how can I maximize value for. And he built up this business, and yeah, so that's another large position. Another one would be RHI Magnesita, which is a refractory business, and so people trade it like a steel stock because it's exposed to the steel industry. So they're like, oh, steel prices are going down, this is horrible. But what these guys do is they sell the kind of the rocks, the magnetite and dolomite that go around like kind of the vats. You have like a burning vat of steel, right? And you basically have this protective layer where it doesn't burn through when it's like boiling at 2,000 degrees Celsius. But they have to be replaced constantly because, well, you're burning steel at 2,000 degrees Celsius in there. But it's a very, it's 1.5–2% of the total cost of like a ton of steel, so it's immaterial. They're more concerned about what the raw materials, what's happening in coke and coal, and what's happening in iron ore, and they're not so concerned about whether the price of refractories goes up by 5% because it's such a small amount and it's being constantly consumed. And so while volumes matter, and actually volumes this year in steel are worldwide are up, they're not down. They're insulated against the price movements. I mean, obviously, if the price goes down so much where the volumes, they start closing down, turn off the vats. Whether the vat's full or half full doesn't matter; they're still burning through. But if they shut down a blast furnace, then it'd be a problem for this company. But don't seem to be anywhere close to that. But the company is trading as if it was a steel stock and that prices were terrible and that's like the end of the world. And yeah, it's a great time to buy, again, a high quality company that's selling a consumable product that's very essential to the end product, but is not, but is very minor cost. So yeah, it's another kind of similar thing.
Yeah, we went through a bunch of ideas, really interesting. If you have more questions here in the room, we can do one more. Yes, we have one here in the second row.
Only one question about the last company, and thank you for the presentation. It was very interesting. Do they do the? Is it only for blast furnaces, no electric furnaces?
They also do electric arc furnaces. And actually, electric arc furnaces uses 2.5 times the amount of refractories that blast furnace do.
And what do you think about the transition to electric arc furnaces, especially maybe in China, where more scrap steel, and less pollution and everything?
Yeah, absolutely.
What's the plan of the company, maybe?
Yeah, so they're expanding in China. And it's one of our key growth markets there in Turkey, where Turkey is another country where electric arc furnaces are very prevalent compared to blast furnaces. But yeah, I totally, they're environmentally better, and you have scrap and you're basically recycling. So, and they're significantly cheaper to build, and they're environmentally friendly. So you should definitely build mini mills and not, which is why COBAS has a position in a company called Danieli, which is a major builder of mini mills or electric arc furnaces. And yeah, I mean, there's definitely going to be a global move. I mean, you still need blast furnaces for really high quality stuff. If you're building rocket ships or really high end, cars, like you still need to have a blast furnace. But for most, goods, when you're, I don't know, whatever stuff around your white goods and everything, and for most uses, electric arc is fine. And
thank you.
Okay, and lastly, we had another question coming from the streaming, and he's directly asking, I will just read it. I would like to ask, are we American citizens allowed to invest in Europe, and how? I trade through TD Ameritrade. I don't know if you can give him any advice.
Yeah, so my advice is don't do that. Okay. Yeah, unfortunately, the great USA has a rule called PFIC, which is passive investment something or other, and basically they treat the underlying foreign funds that aren't US based as a pass-through, which means every time I buy and sell something in the fund, you're basically having to do the capital gains, and you have to write out every single position on your tax return and stuff, and it would be, I mean, you could do it, and people do it, but I mean, it's...
Tax-wise?
Tax-wise, it would not be the most efficient thing you can do unless... Yeah, well, it equals out over time, but like you'd be paying your tax advisor a lot of money. So I mean, if you already have a tax advisor and it's an insignificant cost to you to do all this extra work, then then it's worth it. But for the U.S., it'd be better if you did it through an endowment or something where it's a non-taxable entity. There is ways around that. I'm invested in my fund with a significant amount of money, but most of that is through. So there's a pension treaty with the UK, which you can exploit. And then it helps to have a foreign wife that doesn't have a U.S. passport.
Okay, Peter, so also to all of our audience, you might already know it, but if you don't, just let me tell you, all of our incredible guests come here without receiving any kind of payment, as long as I know, that's perfect. So, but Peter, don't worry about it, because we have a great gift for you, but it has a little catch. Yeah. In exchange for this book, which is Invirtiendo a Largo Plazo from Francisco García Paramés, so you're going to take the challenge to read it in Spanish. Yeah. It's actually also, for anyone who's interested, it's also translated to English and also French, and very soon it will be in more languages. But you're going to take the challenge to read this in Spanish. So just for all of our audience, please tell us a little bit more about what are your favorite books. These can be non-investing books and also investing books.
Wow, non-investing books, like, oof. I have a 9-month-old son. I don't think I've read a non-investing book in quite a while. But yeah, investing books, I think I already named the 3 that I think are key. Philosophy is Seth Klarman's Margin of Safety for kind of practical how do you actually kind of execute like an investment process, it would be You Could Be a Stock Market Genius by Joel Greenblatt, and by understanding competitive advantages, Bruce Greenwald's Competition Demystified. And then those are all investing, but actually reading business books and about like entrepreneurs and stuff, like about the book about Sam Walton, or about Ray Kroc, and about what is it, Shoe Dog?
Shoe Dog, yeah.
The Nike Phil Knight story. I mean, you read as many of those as you can. Those are seeing the success and failures of businesses, and also read the ones about failure too. There's several good books about people who blew themselves up and lost all their shirt, and it's always interesting to see what they did wrong. There's several around the tech bubble where there's good books about people who blew themselves up and thought they were amazing and then weren't.
Okay, Peter, thank you very much. Here you have your gift. I think you've earned it. And also, thank you very much for your presentation, and best wishes for you and Palm Harbour in the future.
Great, thank you.
Y cambio ya al español. Muchas gracias a todos los que nos habéis seguido aquí, bueno, en sala, como decía antes al principio, también por streaming, y a los que nos estáis viendo en vídeo. Pero para vosotros que nos estáis viendo en directo, tengo también pequeños anuncios que hacer. Mañana vamos a estar en Valencia, si hoy nos está viendo desde Valencia, vamos a estar en Buscando Valor, el evento organizado en colaboración con Rankia y con Va de Valor, donde van a estar los mejores gestores nacionales exponiendo también sus ideas basadas en la inversión en valor. Entonces, si les interesa esto, les recomendamos que vayan. Y aparte también, aquí en nuestra sede vamos a tener eventos en las 2 semanas siguientes de este mes. El próximo lunes 23 de septiembre tendremos aquí con nosotros a Enrique García Sáez de Investia, director de la cartera Value, en un evento titulado Invertir en valor en el sector retail, donde están las oportunidades. O sea que interesantísimo. Y una semana después, el 30 de septiembre, también lunes, recibiremos a Tomás Epeldegui de Degusa y a José Manuel López Zafra, que es actuario y profesor en CUNEF, para hablar sobre un tema muy interesante: cómo ahorrar e invertir en oro para proteger y aumentar tu riqueza a largo plazo. Así que hasta aquí el evento de hoy. Nos despedimos. Muchísimas gracias a todos y nos vemos en la próxima. Thank you, Peter.